So in this video, we're going to look at Caterpillar. The ticker is CAT, and we're going to do a discounted cash flow model on this company to find out what the stock is really worth according to their financials. And to start off, we need the market cap, 60.873 billion. And what is the share price? 112.47. Now, what we're going to do is calculate the future expected free cash flow and then discount it back to today's dollars and divide that number by 541 million. And that will give us the intrinsic value, the stock price, based on the company's financials. And then we could identify whether it's a value stock or whether it's being sold at a premium. So let's get started. Free cash flow. This is a really important number that most people don't really focus on, but they really should, because this is the cash that's left over after operating the business. You could think of it as if you bought a business, anytime you buy stock, think of it as buying an entire business. If you bought a business from someone, you would want to know how much cash they generate and then how much is left over for them. And if they said, oh, after all my expenses, there's $50,000 left over for myself. And then you would ask, do you pay yourself a salary? Yes, also I pay myself $50,000. So that particular company would generate $100,000 for you as the business owner. And that's how you value the company, based on the cash it generates. And free cash flow is cash flow from operations minus capital expenditures. And they have free cash flow every year, and it's a healthy number, 2.7 to 4.2 billion a year. And let's look at their revenue. And revenue looks like it increased nicely year to year. Put that in the wrong spot. So the revenue went from 38 to 45 to 54. It actually dropped from 54 to 53. But that's a pretty nice jump from 38. It's interesting to see that they had negative net income in 2016. And I would look into that and try to identify why they had negative net income. It may not be so easy to identify in Yahoo Finance. Definitely in a 10K you can. It looks like it's from this total other income / expense field. So in Yahoo, they don't list every single item on the income statement. You have to go to the 10K and you could see all the detail. And there's also notes in the 10K. So that's where I would go. But for the purpose of this video, we're not going to go into that depth. We just want to look at their numbers and then calculate their weighted average cost of capital. So to calculate the WACC, we need to get the interest this company pays on its debt. And it pays $421 million on its debt. And let's see how much debt they have. And the short-term debt is the current debt that's due within 1 year. And that's 11.4 billion. And the long-term debt, which is debt that's due beyond 1 year, is 26 billion. $26 billion. So they only pay 1.12% interest on the debt. That's really low. Those are good rates. They're a big company, so they do get better terms than a smaller company. Now let's see their income before taxes. Income before taxes, 7.8 billion. And now their income tax is 1.7 billion. So their effective tax rate is 22%. So even though they pay 1.12% interest on the debt, they actually discounted your effective tax rate. So they only pay 0.87% on their debt. That's really good terms. So this should make you feel comfortable as an investor. But my only concern is they have a lot of debt that's due this year, $11 billion. So if they can't get favorable terms, they may have to pay a higher interest rate, because companies don't usually pay off their debt. They just kind of roll it over to new debt. So let's calculate their beta, which is the volatility of the stock. Pretty good beta. It moves pretty much with the market. So the cost of equity is 10.61%. Equity is always more costly than debt, because equity, there's a lot more risk involved than with debt. They're a lot lower in a capital structure. So if there was a bankruptcy, the equity holders generally get nothing. So the weighted average cost of capital is 6.9%, and that's what we have to discount the future cash flows by, because that's how much money it costs this company to generate funds. So that's how much they can earn from year to year. So we're going to use that discount rate of 6.9%. As you can see, they have a negative free cash flow according to the model. And this is, as an analyst, this is kind of our job to look at the model to see what is wrong. And you can see that this 1 year, with the negative income, because part of the calculation, I need to get their free cash flow over the net income. And in this case, it's negative 4,000%. And when you average it with these, it comes out to a big negative. So obviously that's a small hiccup, and it's only negative 67 million. So that really kind of throws off the model a lot. And I think if we just change this to 0, I don't think, well, let's just change this to $1 so we don't, negative 67 million. I'm going to just change this number to 0 because it's really messing up the model, and I don't think that's too material, that number. I could even go a negative, let's do a negative 50%, just so we're not totally cheating. That's being conservative by not putting a 0, negative 50%. So it still has a positive on the free cash flows, and everything else looks good on the numbers. They do have one drop in revenue, and that's accounted for in the model. But let's see the estimated free cash flow. In year 1, which would be 2021, it's a 4.7 billion, and then year 2, 3, 4, and then we do a terminal value after year 4, which is all the future free cash flows every year after that. And that's 145 billion. We discount those numbers by the appropriate weighted average cost of capital, and we get a present value of future cash flows of $130 billion. And when you divide that by the shares outstanding, we estimate the stock price at $240, which is a 53% discount from where it's actually trading at. So it's actually trading half of what we're calculating the intrinsic value at. So let's look at the stock price the past few years. So I think it peaked around maybe 130 or so. So it's been trading under intrinsic for a while. Now, it could be, for many reasons, a company trades under intrinsic value. Maybe people don't feel the stock is worth as much as the numbers say. You don't always look at the past when you look at a company. You have to look into the future too. You have to kind of judge, will this company be viable? And if they are viable, will their sales continue to grow? And will they still have a strong infrastructure? And there's a lot to look at, competition. So this is definitely a strong company. Their revenue did stay steady. And during coronavirus, I do expect them to have a little more trouble. But interesting to see, it's trading at a pretty nice discount. So according to the model, it's a buy. So let me know in the comments what you thought of this. If you have any other ideas and if you want me to look at any other companies.